Thank you for joining us. My name is Brent Leadbetter. I'm head of solutions here at Research Affiliates. I'm excited to moderate this Q&A session with our CIO of Multi-Asset Strategies, Jim Masturzo. Speaking of this Q&A format, thank you very much to all of those of you who submitted questions in advance, as you've literally made my job quite easy. We've received a great list of inquiries on which I'm looking forward to hearing Jim opine today. Jim's going to walk through our current long-term outlook along with shorter horizon signals that may suggest the potential for some short-term opportunities. Interestingly, we're seeing a reasonable amount of agreement between the long-term and short-term indicators. But with that, I'll end my preamble there and get right to the questions. I'm going to start with the obvious. Jim, what are our current long-term expectations, return expectations for headline asset classes?
Thanks, Brent. So to answer that question, I'm going to utilize our asset allocation interactive tool, which many of you I'm sure are familiar with. For those of you that aren't, we actually publish our long-term expected returns and have for about a decade within a website that we call Asset Allocation Interactive. Free to use and available at the URL interactive.researchaffiliates.com. So again, really easy to use and completely freely available. So we're going to start here on our scatter plot of expected returns. So I'm actually going to show this in nominal terms very quickly. I think that's a little more comfortable for many of you to think about things in nominal as opposed to real terms, but the tool supports both. So if we just bounce around this scatter plot, there's quite a few symbols going on here, but I'm going to start right here just for comfort at what we call U.S. large. So this is the asset class that represents, you can think of it as the S&P 500. And so we forecast over the next 10 years for a nominal return at 4% per annum. So 4% per year over the next 10 years. To add a little more transparency, I've gone ahead and clicked on U.S. large here, and we can see that we utilize a building blocks approach to get to that 4%. So it's really the summation of three components. The starting dividend yield, which is about 1.5% currently. Our expectation for earnings per share growth, which is about 5.1. I'll drill in here real quick and show that real earnings per share growth is about 2.6 by our models, and our expectation for inflation over the next 10 years is about 2.5. And then a pretty severe headwind, what we call valuation change of minus 260 basis points. What that means is that we expect multiples, in this case, the CAPE ratio, to compress over that time. So you put all that together, you get a 4% return. Now, as we can see, if I zoom back out here to our scatter plot, there's a lot of other opportunities and many things that look more attractive than U.S. equities, at least to us anyways, based on our models. All the way up here in the upper right, the highest return that we show here, emerging market equities, at more than double the U.S. number, at almost 10% per year, again, for the next 10 years. Moving out of the equity space, if I come down here to the blue circles, we can see bond categories. They're all kind of in this clump here. So just to pick on U.S. Treasuries, 4.6%. With a lot less vol than we're seeing from U.S. equities. So, there's a pretty attractive set here of everything on the chart here being above 4%, which is something that a few years ago we didn't necessarily see.
Along those lines, I think that's a good segue. What we didn't see a couple of years ago, we received a few questions along the lines of, what sort of changes have we seen, right? Everything went down in most asset classes went down in 22, most asset classes went up in 23. How have our long-term forecasts for asset classes changed over the last couple of years?
Yeah, it's a great question. If you, or maybe I should say, for those that have utilized the tool or seen our presentations, when you look at a scatter plot like this, call it the shape of things remains relatively similar, right? And we all know this from basic finance that for higher risk assets, we should expect a higher return on average. Now, these dots will move around. Sometimes they'll be a little higher, a little lower relative to other things. But over the last couple of years, what we've seen, and if we think back just 24 months or so to the end of 2021. I think that's a good time to kind of benchmark where the changes from there. What we saw since then was a sell-off in 2022. So basically, most major asset classes had a negative return in 2022, with the exception of commodities, at least through the first 3 quarters of that year. And then there was even a sell-off in commodities in Q4. Well, on average, we should think about the fact that there's an inverse correlation between realized returns and expected returns. So as realized returns are negative, that usually means things like multiples compress, growth rates may increase, those sorts of things. So that negative correlation means that as we saw a sell-off in 2022 of assets, negative returns, that pushed up expected returns. So everything on this chart, even if the shape looks similar to what we would have seen 2 years ago, everything is higher on average by, call it 1 to in some cases even 3%. So everything went up. The other thing we saw, and the other major thing that markets have been dealing with, is an increase in interest rates. And if we think about, the cash rate, we can look at US T-bills here. Our expected return is 3.3%. That's obviously less than the 5% you can get today on T-bills, which basically just means that we forecast a portfolio that's rolling T-bills to get a lower yield than we're getting today, but still pretty healthy at 3.3%. So these increases in yields have actually flattened this efficient frontier. So if you compared this to what we had 2 years ago, this would have been steeper, or more, maybe said more directly, these blue dots, which are all the bonds, would have been a little bit lower relative to the equities. And to drive that point home, I'm just going to pick a couple things here. Let me just click on global ex-US aggregates. So these are global bonds except for the US. And if I click on this, we can see that Sharpe ratio for this asset class based on expected returns is about 0.5. So nice, healthy Sharpe ratio for an asset class like core bonds. US Treasury, short-term treasuries, gets that Sharpe ratio up to 0.62. Now, if we think about, if I click out here, if we go to equities, and let's just go back to EM equities, again, almost a 10% return, but the Sharpe ratio is 0.32. So a lot less than what we're seeing with core bonds. Again, if your motivation is return oriented and you're fine with taking on the volatility, emerging markets can be perfectly fine in your portfolio. Not saying that, but if you're focused on risk adjusted returns, we're really getting paid to move down the curve, to really think about the core bonds given what rates have done. So, to just tie this up and answer your question, Brent, what we've seen in the last 2 years is everything moving up. That's really good for asset allocation, a lot more opportunities. And then we've seen a flattening of the curve, which has moved us down the curve, at least in our models, more towards this blue or the core bond area.
Got it. Thanks. Your comments about rate increases, I think that's related to the next batch of questions. We unsurprisingly received a lot of questions around inflation. And you already alluded to the fact that the site is showing both nominal and real returns. We had a few questions regarding how we go about modeling inflation. Can you walk us through how your team models the inflation component of our nominal return expectations?
Sure, absolutely. So let's move away from the scatter plot here on expected returns, and I'm just going to come over here under what we call views. These views are just various charts and information that we show on the site. So we don't just show expected returns; we show a lot of other things. And I'm going to go down here to where we have global inflation, and a lot to digest here on the page. To make it simple, each one of these boxes or box plots represents a country. And what we're showing here is the range of year-over-year inflation for each country as far back as we can get data. So the first thing to point out is these are over different time frames. We can see, in Spain here, we go back to 1957. But in a country like China, it's much shorter at 1994. But for as much reliable data as we can get, we create this box plot to show the range of historical realized year-over-year inflation prints. The circles, these white circles that we see, that's the current inflation rate in each country, or the most recently reported. And we can see that in many countries, slightly elevated, although getting back towards that median, the white line in the middle, the 50% line. Some are even a little bit below. Again, if we looked at this a year ago, these numbers would have been, or these white circles would have been much, much higher. In the U.S., we got up to almost 9% inflation, so would have been a much, much higher on the chart. And then the X, the black X, is our expectation of average year-over-year inflation for the next 10 years. So let's drill into the U.S. And what I'm going to do is I'm going to actually flip to a different screen. I'm going to click here where we have what we call country view. And that country view, and you can see this for many different countries, but we're defaulting here to the U.S. We can see all of our expectations for growth, CAPE ratios, so on and so forth. But right here where we have inflation, this is exactly the same as we saw in the previous chart where we had every country. It's just blown up a little bit easier to read. So we can see currently inflation, most recent print for headline 3.1. Our expectation is 2.5 over the next 10 years. So that's, when we say average, we mean that's the overall average for every year over the next 10 years. Again, we're starting a little bit higher at 3.1. We're going to end a little bit lower. Now, your question was, how do we think about forecasting this? There are really two main ways to think about forecasting something like inflation. You can do a bottom-up analysis and try to forecast things like, rents and food prices and, used car prices and all these sorts of things, and try to build up a bottom-up forecast over the next 10 years. That's very, very difficult. Every one of those models is going to have some amount of noise. And so that's not an approach that we take. That approach seems to work better if you're thinking about a very short-term, expectation of inflation, or a short-term model. Although, again, there's a lot of noise that can go into that sort of modeling. What we do is something much more straightforward, which is really to look at the historical record and say, what if we just look at what we've seen more recently? So, said a different way, we take an exponentially weighted moving average of realized inflation, and then that builds up what we call our 10-year forecast. So our target point in 10 years, so not the average over 10 years, but in 10 years, that point is determined based on realizations of inflation. And again, it's an exponentially weighted average, so we put a little more weight on the more recent observations. And then with that anchor point in 10 years and our current point, we have a model that basically moves from one to the other. It's not exactly linear, but for the simplification of this conversation, just assume it's a straight line from one to the other. For the all the gory details of how we do this, we actually do publish a methodology document that walks through all the details and all the models. And for anyone that wants the real nuance beyond what I just explained, feel free to check that out.
Great. Thanks, Jim. Final question on long-term expectations before we shift gears and move into the shorter horizon signals that your team looks at. I love this one because I think it captures a question many investors have been asking as trends have extended, and contrarians like us have sounded a little bit like broken records. The questioner is asking if there are structural reasons why growth has beaten value and U.S. equities have outpaced the returns from the rest of the world. I might extend that even further. Are there structural causes of U.S. growth equities dominance relative to other asset classes that we should expect to persist in the future?
Sure, it's a great question. And as you know, Brent, a question we get all the time. So thank you to whoever submitted that question so we can be sure to cover it here. And for that, I'm just going to move down one chart here to our equity market CAPE ratio. So for a moment, I'm going to put the growth and value breakdown aside, although what I'm about to explain is really the same thing that's also occurred in those markets, just to a greater extent. And so if we think about the CAPE ratio here, again, we're showing the same type of box plot that we showed for inflation, which is realized or realizations of the CAPE ratio going all the way back to the late 1800s. So a lot of data here, almost 50 years of data. And what we can see is that currently the CAPE ratio is about 32, which basically means that $32 for every dollar of earnings. Much, much higher than we've seen in the past. In fact, we're in the top 5% of the distribution. This part, right, this dark line right here represents the 95th percentile. So we're above that. Now that number looks high. It was as high as the upper 30s, almost 40, around 2018, 2019, going into 2020, and as high as 44 at the end of the tech bubble. So, more observations out here, but on average, 32 is really stretched relative to history. In fact, our expectation is for a reversion, not all the way back to the median. In fact, our expectation remains outside the 75th percentile at just about 25. So you can think about this as a reversion of about 7 points or 7 CAPE points to where we think equity prices are going to fall. And this ties back to the headwind that I showed when we broke down the building blocks for equity returns. Now, to answer the question more directly, how did we get to a 32? Well, if we think about 32 from a yield perspective, so if we just take an inverse of this 32, that's about 3% a year. So this is our expectation of a yield of about 3% a year, given current prices. We think this should be closer to 4% a year if we take an inverse, just rounding this up to 25. Now, in an era with cheap money, where rates are about zero and you're getting less than 1% on bonds, it's a really nice risk premia from equities over bonds. Even as this moves up towards 40, that's still a 2.5% earnings yield. So you were still earning a positive risk premia by buying equities at stretched prices. Well, today that's not the case. Today, 10-year rates are at 3.9, 4%, depending on the day. So the risk premium in equities is actually 0 to negative. That gives investors choices. It's the same thing we talked about with the efficient frontier flattening. There's more opportunities to get similar returns with much less risk. So as we think about, can this continue? Of course, any trend can continue, but it becomes illogical at some point to continue to pay up for less and less earnings, or have to pay more money for the same amount of earnings when you can get that same kind of return with different asset classes in a different mix.
Great. Thanks, Jim. So we're going to shift gears now. I mentioned that was going to be our last question on long-term expectations. We're going to shift gears now to start looking at potential near-term opportunities. And we want to kick that off, as the slide suggests, by looking at our growth outlook. So Jim, first question related to our growth outlook. What indicators are we monitoring and when it comes to forecasting growth? And how are they influencing our expectations for growth, both in the U.S. and abroad?
Sure. So our Asset Allocation Interactive site focuses on our long-term expectations, which is why we're going to move away from the tool now. And it's important, though, to start there, because building a secular view of the future is an important way to build a portfolio. You don't want to forget these secular trends, as getting on the wrong side of those can really hurt you and really provide a huge headwind for achieving your goals. But the short term is also important. And so if I click through here to some of these slides, let's just look at GDP growth, and just to level set where we're at from a growth perspective from economies. We can see that in the U.S., we can see the time history of GDP growth, or real GDP growth, currently at about 2.9%. So we're right about the median growth, in the U.S. And that's actually, surprisingly enough, for many people out there who see the economy as really not doing very well, that could be a surprise, but really much better than the rest of the world. So in the UK, we're talking about, really scant growth expectations, or realized growth, 60 basis points, far below even the 25th percentile. Similar case in Germany. Germany is negative, recession taking hold in Germany. The manufacturing base in Germany just not what it was, even 5 years ago. External competition has really been hurting that market. Japan, similar to the U.S., right about the median, although the number is less than half. So on average, taking these four markets as a good representation of the largest markets in the world, global growth is nothing to get too excited about. Again, the U.S. looks better than other countries, but even the U.S. is not something that's super exciting at just a median growth rate. So if we switch from what's been happening now to think about the future, how do we think about what's going to happen with growth or quote unquote forecasting growth? And we look at a number of different metrics. There are four represented here. The first one is the Purchasing Managers Index, the PMI. And what we see are PMIs that are below even the 25th percentile. So on average, this number should be compared to 50. Above 50 means expansion. Below 50 means contraction. There's a simple way to think about it. And on average, the median is 54, which means on average we're growing. So at 47, below the 25th percentile, this implies lower growth. New orders minus inventories of the things we're selling. Are we taking them out of inventory or actually producing more? Current is, again, 2.6. We're below the 25th percentile. Also not good for economic growth. As everyone knows, the yield curve, this is the spread of the 10-year to the 3-month. The yield curve has been inverted for quite some time now and remains, really low, as low as we've seen, or not lower than we've seen since the early 1990s. So a really inverted curve. And then the path of cash rates, which compares the short-term T-bill rate to a 3-year average, trailing 3-year average. We know rates have been moving up. So that moving up of rates, we know provides a headwind for growth. Again, really low compared to history. So the rapid expansion of interest rates is really causing that headwind. So, when we look at these four metrics, future growth in the U.S. does not look bright. So even though we've been at the median, this implies lower than trend growth or lower than median growth. If we move to other countries, and here we'll just focus on the PMI. Again, the U.S., this is the same chart we saw on the previous page, but if we look at the U.K., 46, again, lower than the 25th percentile. Same thing for Germany, all the way down at 43. Same thing for Japan. So this idea of our expectations for below trend growth is not just a U.S.-centric thing. It's across all these major markets. I'll click through a few more here. Just to round this out, yield curve spread, again, this is the slope of the yield curve, and in the US, inverted. Same thing in the UK, same thing in Germany. In Japan, we don't see an inverted curve, but we know that Japan in particular has yield curve controls on, and they've been slowly ratcheting up the long end of the curve, but that's a highly controlled yield curve. So, this one is a little less, you need to take this one with an understanding of the fact that this is not completely market determined. Let's move to the next slide and put all this together. So as we think about things like PMIs and new orders minus inventories and slope of the yield curve and path of cash rates, those are all really interesting independently, and they tell a story. What we try to do is put them together into one number. And that number we call probability of slowdown. And so I want to be clear, when we talk about slowdown, we're not talking about recession, non-recession. We're talking about, is our expectation of growth above or below trend? Because in our analysis and the research that we've done, it's really that being above or below trend that drives asset prices. And so here on this slide, we show our probability of slowdown for a number of different groups, the U.S. by itself, developed markets outside the U.S., emerging markets, global, and then this neutral is just the line in the middle. And what we can see is that probabilities of slowdown are quite high. The U.S. is just about 80%, really as high as it's been since the year 2000. Now, that doesn't mean that we're forecasting a deeper recession or deeper slowdown or relative to, say, the financial crisis, which had numbers that were similar to where we are today. What it means is that all of these indicators, the ones I've shown you and others, all come together and are basically pointing in the same direction. There's less less cross information. So there's more agreement is the way to think about it, such that we think that over the next 2 quarters, the probability of being below trend growth is about 80%. 77% in other global markets. Again, this comes from what we saw with Japan, the UK, Germany. Putting these together, a global average of about 66% slowdown, and even in EM, 54%, slightly above average. This one is a little bit closer to a coin flip. But on average, we're seeing slowdown probabilities. And if we tie that back to what we saw with long-term expectations, we're seeing agreement here on where things are going.
In terms of that agreement, Jim, what asset classes are looking attractive given our forecast of an increase slowdown probability?
Sure. So again, if we tie these things together and we say, okay, the efficient frontier or expected returns have all gone up, that's great. That gives us opportunities across a variety of asset classes. We don't have to, concentrate in any particular asset. We've seen a flattening of the efficient frontier, which is telling us things like bonds, government bonds in particular, look more attractive from a Sharpe ratio perspective. So just from a secular view, that's what we can come away with. Then we look at the chart here on probabilities of slowdown. Slowdown probabilities mean that equities usually underperform, risk assets underperform, safe assets outperform. That's another indicator that's in the same direction, which says we should be taking risk off the table. Now, I want to be clear. We're not saying to completely throw away your asset allocation and just buy core bonds. There are a lot of assets, and we don't have the interactive site up anymore, but I encourage everyone to go there and look around at other assets, things like other diversifiers, commodities, tips, REITs, real return type assets. These are really interesting things given their starting yields, given where we are in the cycle. These are things that investors should be thinking about if they don't have them in their portfolios, to put them in their portfolios. Expected returns are quite healthy now, especially as what they were, a couple of years ago.
Thanks, Jim. Final question, and this one I'm going to selfishly ask my own question. Right, you've talked about the agreement between the short-term and the long-term signals. When you see that agreement and some of these asset classes, like core bonds, are looking particularly attractive, what variables are you considering when you're going about sizing those positions? Obviously, you don't want to. Even if you love a given asset class, you don't want to excessively rely on one exposure in your portfolio. How do you go about coming up with an appropriate size for an asset class you're quite fond of?
Sure. I mean, let's be clear on one thing. All models are wrong to some extent. So all of the models that we've built here are telling us the same thing, but we also understand that there's noise in those models. And in fact, when we talk about expected returns, we talk about confidence intervals around those expected returns. So if we knew with 100% certainty that, we're going to grow it below trend and that our expected return is going to happen perfectly, then sure, we would, maybe oversize to certain asset classes. So when we think about how to position things and how to tilt our portfolios from our, maybe baseline allocation, we really need to think about it in terms of a budget, right? And that, let's just call it a risk budget. Now, risk budget can come in many different flavors. There's volatility risk budgets. You might say, look, I'm comfortable taking 10% risk and I don't want to deviate too much from 10%. So how much can I change my mix to incorporate some of these views, but stay close to that 10%? Many investors have a tracking error budget. They don't want to be more than a couple of percent away from some benchmark, used by their neighbors and friends or whoever, wherever that comes from, but there's a tracking error budget. Beta budgets, it may be a little more technical, but beta being our exposure to various asset classes. You might want to maintain your exposure relative in a beta context to a particular portfolio. And then there's liquidity budgets. Obviously, if you need the access to the capital for other uses outside the portfolio, well, you probably want to mute your expectations of what a 10-year expectation can do for you. So in the context of all of those things, these are the things we need to consider. In our portfolios, when we build them, we look at what the mandate is, any benchmarks we have, any of these outside forces that tell us, look, on average, this is the portfolio we want. And then we layer in these views within that, the constraints of those budgets.
Thanks, Jim. And thank you very much to everyone who joined us, especially those of you who submitted questions in advance. We couldn't get to every question that came in, but we'll follow up with those of you whose questions Jim didn't get a chance to answer today. I would also like to encourage everyone to send any additional inquiries they have to info@rallc.com, as we'd welcome the opportunity to answer any additional questions. Finally, I'm assuming everyone watching this is familiar with our website, but I do want to just make a quick mention that you can register on our site to be kept abreast of any future videos we release, as well as any papers that come out from us. For example, our CEO, Chris Brightman, wrote a piece recently talking about the sustainability of government spending, or perhaps more accurately, the unsustainability of government spending. That might be of interest, particularly given some of the questions we had on inflation for today's video. And then finally, you can also follow us on LinkedIn and X/Twitter social media in addition to the website. With that, thank you again, and have a great day.